President Donald Trump said the U.S. would delay an increase in tariffs on $200 billion of Chinese goods set for March 1st, and that a trade deal between the world's two largest economies could be coming soon. But as Trump trumps up hope, China is decidedly mum on the subject. So what does this all mean? What's really going to happen? Joining me is Jacky He. He is Client Portfolio Manager at TD Asset Management, here to shine a little light on this. It is great to have you here.
Thank you for having me.
Let's start with, I guess, we heard from President Trump last Sunday tweeting out that March 1, maybe not. We also heard from Robert Lighthizer today, actually, maybe it's going to take a little longer. But, I just have to decide whose tweet or whose message is more important. Is this a positive signal, do you think, at this point?
Well, if you follow Trump's tweets, right, you may have a feeling like we are getting a deal tomorrow, right?
Yeah.
But we feel like it's still early to say that. But at least the message of delayed deadline is well received by the market, because that typically signals two things, right? One, the negotiation is making substantial progress, and two, both countries hope to have a deal. Like considering like U.S. presidential elections coming up, and China hopes to stabilize their economy as well, right?
Yeah.
But regardless of interim deal or no deal, U.S. and China cooperation and conflict is kind of like protracted and inevitable.
And part of the reason it's so protracted, and I know you and I have talked about this easy, is that, the issues they're dealing with are not small issues. I mean, you have the issue of state-owned enterprises, forced technology transfers, cyber theft, intellectual property protection. Are any of these realistically going to get solved, do you think?
Well, that's harder to say, right? And it's funny, like all media is saying this as a trade war. I feel like a tech war is probably a better fit. In this tech war, certain things does have like room to negotiate. The other one will have like relatively limited room to negotiate.
What about on this tech war? Where would you say there is some common ground? I mean, where do you think they can actually make some progress?
Yeah, as you mentioned, like for example, the IP protection. Both China and the U.S. agreed to enhance IP protection. We already see some tangible steps implemented by China. January 1st, China established a specialized IP court at the national level, right? That's what the U.S. hope to see. And we also see like China's like recent draft foreign investment law also includes a clause that proposed to ban forced technology transfer by government interference. That's also what the U.S. hope to see. But that's not everything's their favorite.
Yeah.
We know, like the end of last year, like President Xi still emphasized to enlarge, strengthen, and optimize the state-owned enterprises. Right? That's not what they like.
And I think also, too, I was just going to interrupt, but because this is the thing, we talked about this earlier, I don't think people really realize how significant and material the state-owned enterprises are.
Yeah, exactly. I think it's helpful to understand like China and U.S. are running on completely different economic structures. Even post-1990s, like SOEs already play a weakened role in Chinese economy, but now they still represent about 1/3 of the GDP, 2/3 of the outbound investment, and 1/5 of the labor market. So if you are completely changing the structure, imagine how many interests you need to touch, right? So it's hard to say they will get everything resolved just overnight. Maybe some modest concession here and there is possible, but
yeah, it's significant to make all those changes. So let's say, they're trying to deal with these issues, which are big. You've got, you're asking a country to change completely the way they do business, essentially, in terms of doing this. What realistically do you think might actually happen then?
Well, there could be something to happen, right? Like, for example, China can. You mean how they can change this?
Yeah, or do you expect to see a full-blown trade war? I mean,
well,
is that the outcome, or would they just think they can't resolve it?
Okay, I just want to clarify that.
Yeah.
So we don't want to see that, first of all. Yeah, in case if that happened, no one will benefit for sure, right?
Yeah.
To China, most obvious impact will be on the technology industry. For U.S., we shouldn't underestimate that impact either. For example, S&P 500 operating margin, we have seen that improved like over 30% since China joined WTO in 2001. That really benefit because U.S. companies have the flexibility to outsource their lower value-added tasks to China, while they can focus more on their higher cost tasks, right? That make U.S. companies more and more profitable and competitive. So if there's a breakdown, right, between like in this global supply chain relationship there will be some adverse impact on U.S. companies' profitability for sure. But what we want to say is like even in the worst scenario, the world is not ending. So let's keep this show going.
Yeah. Let me ask you, so let's even go, I mean, whether there's prolonged negotiations or there is a full-blown trade war, both countries are going to prepare as best as they can to try and get ready for that kind of thing. So having said that, what could we see? I mean, is it currency devaluations? What are the things that could actually happen as this gets ready? Yeah,
it's interesting. They talk about currency devaluation. It's probably part of the deal. We don't know how much flexibility China has to depreciate their currency. Let's say, even in the worst case, like let's say China gradually depreciate their currency by 5%, right? People worry about that 25% because that sounds a lot. But if you, that's actually 15% higher than the current tariff. That's if China gradually depreciate currency by like 5%, and China's companies have the ability to lower their costs by, let's say, by another 5%, maybe there's only 5% left for U.S. companies to digest. And if you pass that 5% to end consumers, is that a huge deal as people feared in December? Probably not. I'll give you a real-life example. People asked my 5-year daughters, like, what do you do after school? Well, they literally said gymnastics, swimming, and dollar store.
Yes, dollar store. I
know exactly.
It well.
Because I do take them to dollar store to reward their hard studying.
Yeah.
But let's say this dollar store becomes a $1.25 store.
Yeah.
Will I still go? Yeah, I think the answer is yes.
Yeah.
Yeah, I can't stand there crying.
So you have to do it.
Yeah, I have to do it.
Let me ask you then. So, it's not going to change, your daughter's behavior. I mean, the question is, does it change larger behavior in terms of companies, in terms of what they're doing too? Yeah. Where does this leave an investor? I mean, how does an investor have to prepare for this kind of thing?
Yeah, I think investors always worry about headlines, volatilities, things like that, right? I think history is a good lesson. Like if we look back, even during the Cold War, I have a chart. Even during the Cold War, the U.S. equities still deliver pretty solid returns as long as investors keep a long-term investment perspective rather than a short-term speculation mindset, it should get some corresponding returns. All
right, let's bring up that chart. I think we've got an S&P 500. It's annualized total return during the Cold War. And again, you're saying like you can have strife, but still, stocks will still perform if they're good quality stocks.
Yeah.
Which brings me to my next. I mean, I know that. Any examples of companies, and just as an illustration for people, the kinds of things they should think about.
Right. So. As investment professional, our team's job is more like really finding certainty in uncertain times. Like what certainty means to us is really high quality companies and their stable dividends. So we want to invest in companies that not only pay dividends, but also grow dividends year after year after year. Right? You mentioned an example like Johnson & Johnson is a great example, right? It's a boring company. We like to be boring. So lots of history, a good balance sheet, stable free cash flow, and if you look at credit rating, even higher than U.S. government.
Yeah.
Right? And what's more interesting to us is the company has grown its dividend for 56 consecutive years. What that means is it's 16 years before U.S. and China even started that diplomatic ties.
Right.
So that's important because imagine through the half century, like how many market recessions happen, right? So the company can still not never cut or postpone their dividend, continue to grow it, and that's the company we want to invest in.